Hello, everyone, and welcome back to day two of real estate investing. Today, I'm going to be talking about different financing options for real estate investments. Today, we're going to discuss 15 years versus 30-year mortgages specifically. Okay, but before we do that, I first want to talk about what is leverage. So basically, leverage is the ability to use the bank's money to buy assets that appreciate over time and generate income for you. So, for example, let's say that Brooklyn buys a house and the house costs $750,000. So, let's say that she doesn't have or does not want to spend the $750,000 to get it. So, she puts 20% down, right? 20% of the overall purchase price down on the house, which means upfront she pays $150,000 and gets a 10-year mortgage to cover the rest, meaning that she's going to make monthly payments to slowly but surely pay back this $600,000 that she owes. And with payments, it'll partly be principal that are it's actually going to pay down the loan. And then there's also going to be interest, right? Interest, which is just extra money that the bank is charging in order to let her do this, right? In order for her to borrow money from them, they need something in return, and that's money, right? That's interest money. So after 10 years, the fully paid off property is worth $1.5 million, so it doubled in value. Historically, there are certainly places out there where real estate does double in value after about 10 years, historically, which is good. And the interest paid is about $200,000, assuming a 6% interest rate, which is a pretty high interest rate, all things considered. Do look up the norms in the place where you live, but typically it's not going to go past 6%, or at least I hope not. It has at some points, but in the recent past, not really. Hopefully, even with the whole this whole inflation crisis. But anyways, regardless, that's not really the point. The point here is that she only put down $150,000, right? And yet she was able to therefore own and have full control over an asset that was really worth $750,000, right? And so the asset went up in value relative to not how much she put down, but relative to how much the asset is worth, right? Because whether she bought it with a mortgage or didn't buy it with a mortgage, it's still the same asset, right? It's not as though a future home buyer is going to say, "Oh, well, how much did you put down on this?" And that's going to determine how much it's worth now. Well, no, that it doesn't work like that, right? It just matters what is this house and other houses that are similar selling for after 10 years, and that's about how much it's worth, right? It's worth what somebody will pay for it at the end of the day. And so she put down $150,000, and she was able to get a huge return on that, right? She was able to then have $1.5 million. And over time, how much did she pay? Well, she did have to pay the $600,000 back plus $200,000 worth of interest. So in total, she paid $800,000 throughout, just by making the mortgage payments. And then she also paid the $150,000 originally. And she now has an asset worth $1.5 million, right? So if you think about the rates at which that's occurring, that's a pretty good investment, right? Over time, she paid, it was under $1 million, and now it's worth $1.5 million. Now, we do have to, of course, if we wanted to do an exact breakdown of this, we would have to account for inflation and the fact that the later mortgage payments are going to, if the mortgage payments, assuming they're all the same dollar amount, right, the later mortgage payments aren't going to cost her as much as the earlier mortgage payments due to inflation, right? And the 150 down is going to be more than 150 is worth down the road, that sort of thing, right? But overall, she's really come out ahead here by using leverage. Basically, she was able to borrow the bank's money to have an asset that was worth more than she had actually paid for it and put into it. But she's at the end of the day, she's the one who owns the asset, right? Let's do another example, right? Let's say that she only owned the house for 5 years, let's say, and the mortgage wasn't fully paid off. Well, she would still get however much the house appreciated, she would still get that, right? If she sold, she would still get to keep that. She'd have to, of course, pay off the remainder of the mortgage, and there may be a fee for, ending the mortgage early from the bank. However, at the end of the day, she would still get to keep that profit, right? Minus any real estate fees and other expenses like that. Essentially, she would get to keep the profit after paying everything that she would have to pay for in that scenario. Okay, so let's talk about how do you actually calculate your mortgage payment. So the monthly mortgage payment is going to be the principal, right? It involves principal here. Principal is just the amount of money that's being borrowed. So in the previous example, the principal that she would have to pay off over the 10 years is $600,000. So 600,000 would go in P in this case. The next one is I, which is the monthly interest rate. So keep in mind, this is monthly interest rate, not yearly interest rate. So if they give you a yearly interest rate like 6%, it says assuming a 6% interest rate, we're going to assume that's yearly, because if that were monthly, that would be just way too high. In fact, perhaps so high it's probably illegal in some places, I would guess. So, anyways, we would have to divide by 12 to get the monthly interest rate, and that would go in I. And then we would also have to calculate the number of payments required. So in our previous example, since she's making payments every month for 10 years, and there are 12 months in 1 year, then it would be 12 times 10, which is 120 payments required in total. Right? Similar math tells us that it would be 360 payments if we had a 30-year mortgage and we paid that mortgage once per month, right? Because 12 times 30, 12 times 30 would be 360. So 360 payments in total for a 30-year mortgage. Good. Okay. So I want to give a couple examples here with a 15-year mortgage and a 30-year mortgage. So let's start with a 15-year mortgage. So let's say, for example, that somebody bought a property that cost $1 million and they got an interest rate which is about 3.8%, and it's a fixed term mortgage. So that never ever changes. And it's a $200,000 down payment, which is pretty common, right? About 20% down payment. And therefore their mortgage was $800,000. So they borrow $800,000 from the bank to buy this $1 million property. They pay $200,000 upfront. So in this case, the monthly mortgage payment, according to our calculations, would be $5,837.64. So they pay this every month for 15 years, and then at the end of it, they have a fully paid off property that's probably now worth hopefully more than, after 15 years, hopefully it's worth more than $1 million. But let's also calculate how much principal was paid off versus interest. If we multiply this number, $5,837.64, if we multiply that number by the number of payments, which is 180 payments, we will get the total that was paid, right? So the total that was paid was $1,050,775.20. So over the course of these 15 years, that's how much was paid. Now we know that 800,000 of that was the principal, right? 800,000 of that, the reason we paid it was to get rid of this loan, right? At the end of paying this, we no longer owe the bank any money, right? Unless we owe them for other stuff, but we don't owe them any money from this. And the rest of it that didn't go to that must have been interest, right? So we also paid $250,000 and $775.20 in interest as compensation for the bank allowing us to do this, basically. Okay, so that's that. Okay, let's do another example with a 30-year mortgage. So let's say we're doing a 30-year mortgage, same everything, except notice the interest rate's a bit higher. I made it a little bit higher on purpose. I made it 0.5% higher because oftentimes if you do a shorter loan, they do often give you a better interest rate. So the same bank giving you a 30-year mortgage or a 15-year mortgage is going to offer you a slightly better interest rate if you choose a shorter mortgage just because of the risk factors for them, right? And so that's what they would decide to do. So it is a slightly higher interest rate. So in this case, still a fixed term mortgage, though, still the same $1 million property, still the same $200,000 down payment and $800,000 mortgage, right? So in this case, we do the same calculation and we get that for 30 years, we have to pay $3,958.97. So basically just shy of $4,000 a month in order to own this property in terms of what we must pay for the mortgage. So that is quite a bit less. That's almost $2,000 less. I guess not quite $2,000 less, but almost $2,000 less than we got before. However, keep in mind that this one we have to pay every month for 30 years. The other one we only have to pay every month for 15 years. So, we're all done 15 years early, right? Once we're halfway through this mortgage, or halfway through making the payments on this mortgage, I should say, where we would have fully paid off this other mortgage here. Okay. So in this case, the total that's paid, again, we can take this number and multiply by 360 to calculate the total amount we paid was about $1.4 million. Right now, we know 800,000 of that was principal, so therefore the other $625,000 and $229.20, we want to be that exact, must have been interest. So on the surface here, it seems like the better deal is the 15-year mortgage if we're able to comfortably afford the payments, because here we pay way less interest, right? Here we pay more than double the interest that we pay. And at the end of the 30 years, or in the other case, the end of the 15 years, we have the same fully paid off property. But here's something to consider about leverage, and this might be interesting. So let's do a side by side comparison of these two things, right? We bought the same property, we just chose different financing options, is the way to look at this here. So, for the 15-year mortgage, after 15 years have passed, we now have a fully paid off property and have paid $5,837.64 per month. So, for the next 15 years, let's continue investing that money, right? That mortgage payment, the money we were putting into the mortgage, we're now going to continue to we're just going to put that money in the stock market at a 7% return for the next 15 years. And now 30 years have passed, right? So, long story short, the first 15 years for the 15-year mortgage, we put the full amount towards the mortgage because that's how much the mortgage cost. And then after that, we use the same money we would be using for the mortgage to invest in the stock market at a 7% return. And we do that for another 15 years. So 30 years has now passed because first 15 years was mortgage payments, next 15 years is stock market. So now we're 30 years old, or 30 years have passed. Now, what about on the 30-year mortgage? After 30 years, we still have a fully paid off property, and we pay $3,958.57 per month on the mortgage, and we spent the difference between the payment of the 15-year option and 30-year option, which is about $2,000, or more accurately, it's $1,879.07 for the full 30 years. Right? So in this case, we're paying the same amount. However, we're putting $3,958.57 to the mortgage, and then we're paying the rest of this $5,837.64 number. We're putting that into the stock market, and we're doing that all 30 of the years. So either way, the amount we're putting into this, investment slash mortgage plan is the same, because either way, we're putting $5,837.64 per month into either a mortgage or into the stock market, or in the case of the 30-year mortgage, we're doing a combination of both throughout the entire duration here. So how much would we have from our stocks, right? We know we have a fully paid off property that 30 years ago was worth $1 million. Probably by now, I would imagine worth a few more $1 million than that, like possibly, $4 or $5 million. I'm not really sure. If we go based on the, this assumption that it doubles every 10 years, well, 3 10-year periods happen. So that would suggest that perhaps, it went from 2 to 4 to 8 million. Whether or not that would actually be accurate, I am not sure. However, it's safe to say this property will have, is almost guaranteed to be worth a lot more than the $1 million we got for it, right? So we have whatever we made from owning this property over 30 years, which is hopefully a lot of money by that point. And then we also have the money we invested in the stock market. And if we use our future value equation that we learned in our last course on personal finance, it turns out that in this case we have $1.85 million invested in the stock market in this way, and here we have $2.27 million. So we have quite a bit more, right? We got over $400,000 more, which is not chump change. That's a lot of money more by doing it this way. And so the point I want to make with all of this is to make sure that you do your research, go to different banks, find the best interest rates, because that is going to help you, right? That is going to get you a lot more, a lot more insight. And also, it's worth doing these calculations. It's worth going to the banks, figuring out the rates, the best rates that you can get, and also calculating the mortgage payment and the future value of each option, right? Put them out side by side like this with the interest rates to see what is going to be the better option. Now, that said, also make sure you really follow through with this plan, right? If you end up just doing the 30-year mortgage and, not actually investing this difference, then it's not going to have the same results, right? Whereas this 15-year mortgage, it forces you to do that. But that said, with the 15-year mortgage, you have to have discipline as well for the second 15 years to make sure you also invest it in the stock market as well to get this result, right? So it is important either way to make sure that any plan you have on paper is something you can realistically stick to. That's important, right? However, sometimes the point of this is that sometimes the 30-year mortgage is the better option, even though on the surface it looked like, oh, that's way more interest that we're paying the bank. So isn't that the worst option? And initially, yeah, it does seem like it's the worst option, even though it isn't, because it has more leverage. It frees up more cash flow so that we can use that money to invest in the stock market for longer and create more long-term gains, even though it's less money that we're putting in the stock market each month in this case than it is in this case. We start 15 years later. In this case, there is way less time for this money to compound, right? The power of compound interest is huge, especially over, a 30-year period. That's a long time. So definitely make sure that you consider all the options you have and do these calculations for yourself. Or you can even use a calculator online if you don't want to do the calculations out by hand. This is not a math class. This is not about making sure you can do the calculations by hand. I do not care about that. I care about making sure that you optimize this strategy to be the best you can. And even though it's maybe not the most fun for everybody, it is, think about the, potential consequences of doing this are huge, right? Are going to be hugely important for you. So definitely make sure you do. So long story short, do your research, go to the banks, find out what their interest rates are for the different mortgage terms, and then also calculate each mortgage payment and future value of the options as well is key. All right, well, that is everything. Good work today, everyone, and I will see you next day. Bye, everyone. Whew.